It may be time to seriously consider keeping a portion of your wealth outside the financial system. Not because disaster is guaranteed, but because when restrictions arrive, they usually arrive suddenly. By the time people realize they need access to their money, the door is often already closed. History shows us how this works. After World War II, U.S. government debt rose to more than 120% of GDP. GDP represents the total value of everything produced in a year, and even at that extreme level, the government managed to reduce its debt over time. They did not do this by paying it off directly. Instead, spending was reduced, productivity increased, interest rates were held artificially low, and inflation slowly eroded the real value of debt. Financial controls limited where people could store their money quietly, forcing savings into government assets. Eventually, debt levels dropped, but once they became manageable, borrowing began again. From the 1980s onward, the government steadily increased leverage as interest rates fell. Today, debt has returned to roughly the same level as it was after World War II. The difference is that this time, there is no war spending to end. Most government expenses are tied to entitlement programs that cannot easily be reduced. Even eliminating discretionary spending would not fix the deficit. The workforce situation is also different. After World War II, millions returned to work, boosting productivity and growth. Today, most people who can work already are. That removes one of the key tools that helped in the past. This leaves inflation as the primary way to manage debt. Inflation only works if people are forced to absorb the loss. If individuals protect their savings, the system struggles. This is why governments use financial repression policies that quietly trap money inside the system. These can include capped interest rates, limits on foreign investments, or controls on capital movement. The goal is not accidental. It is to create a captive market for government debt, while purchasing power slowly decline. As people find new ways to protect themselves, discussions around tighter financial controls become more common. Limiting mobility, restricting offshore assets, or discouraging alternative stores of value all serve the same purpose. That is why having options in advance matters. One way people do this is through physical gold stored outside their home country. Not paper gold, but allocated, insured, and independently audited gold held in private vaults located in jurisdictions with strong property rights. Another option is Bitcoin, which allows wealth to be stored and moved without permission when held properly. It is not dependent on banks or governments. Real estate also plays a role, a cash-flowing property with long-term fixed debt benefits from inflation as future dollars repay today's loans. Property in other countries can also provide diversification or residency options. Beyond assets, skills and businesses matter. The ability to earn independently is something no system can confiscate. Throughout history, those with skills rebuilt fastest when systems failed. Finally, second citizenship, or legal residency, offers mobility. These options are becoming more limited, which often signals growing demand. The real risk is waiting too long. Having wealth outside the system and never needing it is far better than needing it when it is no longer accessible. Thanks for watching and supporting me.